Happy Friday, everyone, and thank you for joining me again as I continued my series Surviving COVID 19 A Financial Perspective. In my last video, which was the first part of a two-part series, we looked at managing your personal finances as it relates to budgeting. And I gave you 4 ways in which you can do that. Now, today I'm going to give you the final 4. But by way of review, let me remind you what we discussed 2 days ago in relation to managing your personal finances. We looked at 4 ways. 1, knowing where you stand. 2, re-evaluating your budget. 3, reduce your spending as much as possible. And 4, creating non-cash income. Now today we'll be looking at another 4, and it's a little more deeper than the first 4 that we looked at. Now, the 4 that we'll be looking at today includes: 1, do not ignore your credit card payment. 2, maintain your investment program. 3, maintain your risk management program. And 4, taking it one day at a time. Interesting, isn't it? Yes, it is. Now, while I explained in my last video that budgeting has to do with your income, managing your income and your expenditure, it also takes into consideration your savings and investments. Yes, as a matter of fact, your savings and investment portfolio is usually an indication of how effective you are at budgeting, right? Budgeting is not about coming in only and taking out. There's a very important aspect of your budgeting that includes your short-term, your long-term savings, because you have to allocate for these as well, right? Now, the saying that goes that spend what you have after you have saved is part of what we do if we are financially savvy and we want to budget effectively. Now, let me break down the four ways that I mentioned earlier. 1, do not ignore, do not defer, do not delay. So the 3 words I give you: don't defer, delay, or ignore your credit card payment. Most of us would have incurred a lot of credit card expenses over the last month or so, because cash is tight and we're pulling on what we have to see how much we can make ends meet. Now, what we need to remember, or what we need to know for those who don't know, is that the interest rates on credit cards are significantly high, especially on pending credit card payments, right? And just like a regular loan, if you default on your credit card, it speaks bad for your credit history. As a matter of fact, it adds to your credit score. Well, in this case, minus, because the lower your score is, the worse off you will be, and the more hesitant institutions will be in extending credit to you. But I'm not going to delve deep into credit card payments today, because based on some feedback I got from one of my frequent listeners, she had asked that I speak some more about credit cards, and that's a whole different module by itself. So I'm gonna allocate one specific series to discuss managing credit cards, so I won't go deep into it. But ladies and gentlemen, if you're to budget effectively, you cannot ignore your credit card payment. A word of advice: pay at least your minimum payment. Now, what is your minimum payment? Usually when you receive your credit card statement, you'll see, for example, balance due $100, minimum payment $10. That $10 minimum payment is the amount you need to pay on your card without being penalized with a late fee, right? So that's the lowest possible amount you can pay. If you pay below that, or you don't pay any at all, you will be incurring late fee, and the cycle goes on and on and on and on. And I'll explain that in my next video, the effect of having a running balance on the credit card and how interest affects the result of compounding interest on each balance going forward, right? Now, pay at least your minimum payment. And ladies and gentlemen, I implore you, do not, or refrain as much as possible from taking cash advances from your credit card. No, a credit card don't work like a debit card, right? And a credit card is not free money as most persons would think it is, right? It's just money that you have quick access to that you borrow from an institution. The only difference, you don't get the cash in your hand, it's on a card, right? Now, what most credit card holders don't realize is that the interest that the institution charges you for point of sale transactions, those are the transactions like you go to the supermarket or the gas station and you swipe, the interest rate charge on those transactions are usually lower than the interest rate charge on transaction when you use the card at the ABM to do withdrawals, and that is much higher than the point of sale rate that you get when you swipe your card at the point of sale machine, right? Now, manage your credit card wisely. About 4 videos ago, I mentioned in my first set of videos, I was talking about how financial institutions are offering deferment, moratoriums on credit cards and regular loans. I'll say to you, instead of deferring your credit card or taking a moratorium on your credit card, why not take it on your regular loan, like your motor vehicle loan or your mortgage, which carries a much lower interest rate, right? So if you have a throw, so you have a credit card, you have a mortgage, and you have a car loan, doing your budget, you say, okay, let me see, I only have $50 to allocate to these 3 loans, but these 3 loans add up to $80. Where do I give that $30? Give it on your lower interest rate loan. And in this case, it's never usually the credit card, right? So as much as possible, don't ignore your credit card payment. Pay at least the minimum balance. Utilize moratorium. Although there's an interest rate effect on moratorium, it won't be that hard or it won't be that much as if you had taken the moratorium on a credit card. So by now, with 2 months into this pandemic, most of us who would have had loans at institutions, we should have, if you're financially savvy, we should have already gone to our banker to say, hey, this is my situation and I need my moratorium or I need a break. Or so we are not going to go back there, because most of us should have already gone to sort our business out, as it were, right? Having a good credit is very, very important. As I said in some videos ago, your credit score, your credit, bad credit or good credit, stays on your credit report for at least 7 years. And trust me, Corona won't last for the next 7 years. So maintaining a healthy credit score is very important. So do not ignore your credit card payment. Up to take moratorium on a regular lower interest facilities, right? So that's number 5. Number 6, maintain your program of investment. Now that sounds a bit heavy, right? Yeah. Now, your program of investment can be something as simple as your savings for your vacation next year, your saving for your wedding, saving for your end of year, saving for your child's education. It can include anything like that. It can include your pension plan, your shares, your stock, etc., etc. All of that is your personal investment program. Whatever set of investments that you are involved in, that you put some money to each month, that makes up your investment portfolio, right? Now, I'm not going to go into all of that, but what I want to say to you all is that in this time of crisis, there are specifically 2 investment programs that I would want you not to touch, and it should be the very, 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 very last resort. That is if you reach rock bottom and there's absolutely no other way out, that you'll ever even think of touching these. And I'm going to look at 2. Your retirement plan, right? Do not draw down from your retirement plan even if you are financially strapped. Now, if you're a part of a pension scheme where you are making like voluntary contributions to supplement your employer contribution, keep making those payments, right? Now, let me break it down. For some persons, your employer will pay something like 5 to 7 or 5 to 9. I know it's single digits towards your pension. So say, just for argument's sake, your employer pays 5% towards your pension plan. Now, you as an employee, you have the option to match that amount to contribute to your voluntary pension, right? So say 5 years ago, you decide to match it and take 5% of your salary as your pension, your voluntary pension. Now, when persons are strapped for cash, and I've seen that even very close to me, very close to me. Friends of mine did it in the past, and I always say to them that that's a very wrong move. Whenever they're financially strapped, and you know in Jamaica, when persons say they're financially strapped, they're not really financially strapped. There's this one little thing else that they can tap into. And when most persons are financially strapped, they might want to stop their voluntary contribution. That's a no. Keep making those payments. What you don't want to happen is for a couple of months of uncertainty like you're experiencing now to cause you to lapse on your retirement plan. Now, I often tell people that there's a thin line between retirement and retirement. Yes, a very thin line between retirement and retirement. Because, meaning, if you remain disciplined and financially savvy, you can be great during your retirement, or you can just be okay in your retirement, or you can be worse off in your retirement. It would be better to take a loan from a loan shark, one of those same day loan people, right? Whilst to fill that gap, whilst their interest rate is high, it will not carry a negative long-term effect like that of drawing down on your retirement plan. Because say for example you borrow $200,000 from one of the same day loans people, and you pay back that over 15 months, 20 months, 24 months. After 24 months, boom, you're done. But if you touch your retirement plan, it's usually very hard to get back into that momentum, and it's a long-term savings that you would not want to touch, right? So never ever touch your retirement plan. Don't let 2 months of uncertainty affect your long-term goal. We all want to retire in style. We want to all retire and can buy that recliner to put on our back patio, still able to go to the supermarket each month, pay for medication, and still lead a healthy and fulfilling life after you stop working, right? So don't touch your retirement plan. Now, what does that have to do with budgeting? It has everything to do with budgeting, because the amount you pay towards your retirement plan will fall under the expense section of your budget. So you have to budget for it. So when you're doing your budget next month, do not put a line through voluntary contribution and go to HR and say, I'm going to stop. As much as possible, cut something else. Do not touch your retirement plan. The next investment that you should not touch is your stock or your shares. And that's what I spoke about last time. Do not sell. So when I said do not sell, I wasn't stating anything spooky. Do not sell your stock or your shares. Now, the free fall in the local and global stock markets, it's making most investors uncomfortable, because you're seeing portfolios dropping, you're seeing it losing value. And whenever this happens, persons are always tempted to sell and opt out. But let me tell you, that is the worst possible course of action. The value of most stock will stabilize when normalcy returns. If you sell your stock, your shares now, all you'll be doing is just monetizing your losses. In other words, all you'll be doing is just putting a monetary value to your loss. Hold and wait for the volatility to end. Usually a little bit before a recession, during a recession, and a little bit after, things are gonna be a little shaky. But once that period has passed and normalcy returns, then you find that the value of most stocks or shares go right back up to the roof. So hold it, right? Hold your horses. Do not be in a hurry to sell, because all you'll be doing is putting a monetary value to your loss. As a matter of fact, buying shares or stock, it's a risky business. It's a long-term business. So it's not something you jump in and jump out. If you don't know how to manage it, you'll be just losing. Hold it and wait for the volatility to end, right? So those are the two programs of investment that you should not touch. And yes, it has everything to do with budgeting, right? Now, the seventh way is to maintain your risk management program. Now, sounds like I'm getting legal, right? No, I love the whole legal thing. And back in the day, I wanted to be a lawyer at some point in my life. I like the legal terms and so on, but that's not really my field. But I know enough to say to you that you need to maintain your risk management program. Now, what is risk? Let me look at my script here because I wrote down a very simple definition. It says risk, simply put, it's the possibility of something bad happening. Right? Here's some person saying, oh, a risky business that me not going there, too much risk. In this time, when most of us are rightly and should be cutting back on expenses, we may again be inclined to cancel our insurance policies. But allow me to put something into perspective. Now, there are some common insurances I have here. Life insurance, you have your debt coverage plan. For example, if you're a credit union member, you have what they call FIP. You have peril insurance, you have critical illness plans, motor vehicle insurance, and you name it. Now, let's look at the first one, life insurance. So say your spouse has a life insurance. You cover the spouse. And your spouse contracts the coronavirus, having an underlying condition, passes away. If you had canceled that insurance plan, how much financially better off would you be? That's a question. That's a rhetorical question. Worse yet, if that spouse was the major or the only income earner. Now, honestly, I don't like insurance. No. Who does? Nobody. Paying for something that might not happen. But that's it. You're just covering the risk. Now, what I do to comfort myself is to say the financial gain of having an insurance significantly, and when I say significantly outweighs the monthly payment for a good life insurance policy. Cover your risk. Not because you're strapped, and I'm talking to persons who probably may still have their job or still getting some income. Still pay your insurance, because let me tell you something about insurance. Nothing ever happens until you stop paying it. So you're going on nice, paying your insurance, 3, 4, 5, 6, 7, 8, 9 years, nothing happens. You decide to stop it now. You take it out your budget. It's no longer an expense item in your budget. Boom, spouse pass on. Funeral expenses ain't cheap. Worse if children are left behind. Schooling, they're in college. Think about all the possibilities. Now, that's the risk you take when you do not keep up and continue budgeting for your insurance. You have a thing they call peril insurance. Now, peril insurance refers to hazards and events that source of loss or damage. Some common perils, you have flood, fire, hail, lightning, volcano eruptions, etc. Now, for most persons who have a mortgage going now, you might not have to worry about that, because most banks and the National Housing Trust, they kind of clump your peril insurance payment in your monthly payments. So you don't pay for that separately. But for persons who would have not borrowed to purchase their property or don't have a mortgage on their property, they might be inclined to not pay it because, there's no institution saying you must. No, that's a wrong course of action or a wrong way of thinking. Keep paying or start paying your peril insurance. Worse now, the kids are home, and when I was growing up in the summer, houses burned down, children go to river and drown. Everything bad happens in the summer when children are off on break. It's the same thing now with coronavirus. You're home next, child play with match in the kitchen. You might have a wall structure, but it don't burn down, but you're burned out. No, things like that you have to cover. If your house is burnt out now, do you have the finances to cover it? Again, cover your risk. Maintain your risk program. Motor vehicle insurance. Might be some of us can't do without a vehicle. Maybe our work requires that we have a vehicle, you live far from work, and now in the corona, you might be hesitant to take public transportation, so that's understandable. But I was watching TV the other day and I saw this ad on TV, JN Bank, they have a shorty insurance thing. JN Shorty, I think that's a buzz of it. And in essence, they're saying that you don't have to pay your insurance in full. They give you some payment plan, 1 month, 2 months, 3 months, I think. So check that out. Or check out other institutions that might offer plans where you don't have to pay everything one time, but still do not leave your risk uncovered. Cover the risk, because in times of uncertainty, in times of economic downfall, the worst things seem to happen. So put that on your budget. Keep it as an expense item in your budget. Again, you might have to cut some expenses, as I mentioned in series 1, but in some cases you have to maintain them. Worst, if there are risks associated with those items. Now, the final one is to take it one day at a time and keep healthy. And I'm sitting here telling you that also easy, right? Yes, it's not as easy as I make it sound, because you know we all worry, but we have to compose ourselves and be rational, be reasonable with ourselves, set realistic goals. Check your finances regularly. Review your budget at least weekly and ensure that you are on track. And I'm reading this directly from my script. Review your budget at least weekly. Even if you have collated a monthly budget, check on it weekly. That is what we call controlling your budget. Because sometimes if you wait until the end of the month, if there's something that you need to put a check on or a hold on, it would have already gone and you might end up in a deficit. So if you see in week 2, you realize that, okay, I had budget for 30,000 for food, and at the second week I'm at 25,000. Now, you have to make some adjustments. So it's either you start cutting that, okay, guys, we need to start eating less, no more snacking until maybe one time a day or so, or whatever adjustments you need to make, right? So in managing and controlling your budget before the end of the budgeting period is very important. Do not spend it if you did not allocate for it. That is the most important principle in budgeting. If me not have it right down, me not give it. I have a friend of mine who, and I hope he doesn't listen to this video, who, if you see him on the road and ask him for $100, he's gonna say to you, I didn't budget for it. And we might say, oh, he's mean. And when I asked him one day, why do you do that? And he said to me, Nicole, honestly, I budget something that I call giveaway for the month, which is $2,000 or $1,500 that if somebody asks me for $100 or so, I'll give them. And whenever I exhaust that $1,000 or $1,500 in giveaway for the month, if it's at the 5th of the month, I'm not giving anybody else anything. My giveaway fund is depleted. And whilst we might say, oh, you mean and stingy, it's a very prudent way to approach and manage your budget, right? Spend only what is absolutely necessary. I know some of you ladies, you like shopping on Amazon, buying all the fancy dancy stuff and whatever, but no, it's not really the time for that, right? And again, even if you're still working, you have to consider other factors. We don't know what might happen in the next 2 months. So saving and keep maintaining your investment is absolutely necessary, right? Remember, you won't be facing this crisis. Well, we won't be facing this crisis forever. Our situation will improve eventually, and we will feel like we can breathe again. Now, I'll end on that note. So breathe, and deep breathing helps. Inhale with your nose and exhale through your mouth, right? See you in my next video. We'll be looking at how to manage your credit card. Thank you for joining me, and have a wonderful COVID-free weekend.